So I'm recording the lecture, and I trust you all know me. My name is Mr. Mpatsi. For those who don't know me, I'm your tutor for taxation, Zimbabwe variant. I must admit you made a very good decision to enroll for tax, because tax is one of the, I always repeat this statement, and surely before you know it, you shall agree with me in no time, that tax is not necessarily a subject that you should say, this subject gives me issues. If someone is to ask you, which subjects are you writing in December? Clearly you can say I'm writing tax. No, not necessarily per se. You can say I'm writing PM with tax, that kind of thing. I'm writing FR or FM with tax, because tax is kind of a scientific subject. Once you know the principles involved, what constitutes income, what constitutes deductions, what constitutes this, once you acclimate or you familiarize with that, women try, believe you me. And the beauty of it all is you have enrolled with Atlantis Resources, and we have never failed to deliver in this regard. Okay, the objective really of taxation is we want to teach you to be good corporate citizens. When you need to give Caesar what is Caesar's, so to speak, make sure you give government what is due to the government. That's a good corporate citizen. A good citizen pays the tax dues to the government, and government uses that money for quite a lot of issues in its votes or allocations in the budgets, etc. So that one is a very important. It's a very important aspect. We don't teach you tax so that you then evade paying tax. You deliberately, fraudulently avoid paying what is due to the commissioner. That one clearly is not. It's not the reason why. So, as a first lecture, I want us to first list down. Let us, as you can see, the lecture is being recorded, and what you are now seeing here, you are now seeing my screen. So allow me to take you step by step. This is my screen you are seeing. Taxation. Actually, it's principles of taxation, because taxation Zimbabwe. All right. Okay, so let me list the topics. When you are reading, these are the topics I want you, or I want us to study the topics. So what it means is, when you are reading it, whatever you are reading, follow through this particular layout, these particular readings. We shall start with gross income. Gross income. This is the syllabus outline 2. After gross income, we shall look at exempt incomes. Exempt income. Then after exempt income, we then look at 3 deductions. Deductions. 4 prohibited deductions. Prohibited deductions. 5, we look at tax computation. Tax computation. On tax computation, we have 1. We shall have it on employment income. When you are computing tax from employment income, how do you go about it? 2, income from trade and investments. Trade, trusts, and investments. Right? Meaning meaning when you are not earning income, when income is not from an employment contract. And then we shall then do taxation for partners. Taxation of partnership income. Partnership income. Taxation of partnership income. This is number 6. This is number 6, taxation of partnership income. And then number 7, taxation of income from farming. Taxation of income from farming. And then number 8, a capital gains tax. Capital gains tax. Then number 9, value added tax. Also, number 9 is VAT. Value added tax. That's VAT. It stands for value added tax. And then number 10, capital gains tax. And lastly, 11, tax administration. So, okay. What have you noticed here? What we have noticed is we do have this as our taxation syllabus for Zimbabwe. Sorry, and
excuse me, sir.
Yes.
It looks like you repeated capital gains tax. Could there be a topic that we skipped?
Oh, no, you are right. Not necessarily. I repeated it. Actually, I should let me remove it. Remove the repeated. Thanks. You know, this is what I want. Okay. Otherwise, it was getting kind of scary. So 8 here, 9 here, 10. What does it mean? It means you need 2.5 months to complete it. That's what it means. If it's 10 and we have got 3 months, 10 topics, meaning how many weeks? 10 weeks, which is how many months? 2.5 months. That's for your planning. We'll wrap up the topic. Then come next week. As you will notice, next week I'm going to send the notes, which is taxation notes by Mr. Mpatsi. But I can as well send them now, you know. But before I send the notes, let me mention something which is so critical. Well, this is 2021, so we shall be using 2020 Tax Act. We shall be using 2020 Tax Acts. What do I mean by Tax Acts? We have got VAT, Value Added Tax Act. We have got Income Tax Act. We also have Capital Gains Tax Act. So all these are the acts we shall be using. And what does that mean when we realize that we will be using 2020 acts? What it means is the figures. If you are advising a paper for 2020, that question paper was using 2019 acts. So when you are answering a question for 2020, suppose you are doing past papers, know for sure that in some instances, the figures there are no longer applicable to you because you are doing 2020 Act. You can still revise text using 2017 question paper, but certain figures need amendment to 2020. And what are the figures in question that I must highlight so that you know? These topics to do with capital gains tax. This one, if you are doing past papers, meaning prior to 2020, there were remarkable changes to that. Value Added Tax Act. If you are doing papers prior to 2020, there were changes to that. So always know that the figures in the handouts I'm going to send, they need to be reviewed. So don't rely on them concerning these. Why? Because the tax acts change. So you may say, does that mean we cannot then proceed and do questions? You can, but just do that with this in mind. So allow me now to send the taxation notes by Mr. Mpatsi, which are the notes that I have prepared, but with this word of caution that some of the figures on capital gains tax, on VAT, are subject to change. I understand you understand perfectly well what I mean by that. Allow my WhatsApp here to open so that I can send it right away. When I have sent this, it does not, as I have said, these are the notes. I will be jotting down some of the notes on the go so that I will be explaining, but you don't follow really what is, you follow the program of study that I have just highlighted. Let me fish out the notes. No, they are somewhere. Let me fish them out. Taxation notes by Mr. Mpatsi. You have noticed that this has not been updated. So containing capital gains tax, VAT, you need to make use of 2020 Tax Act. And then the 2020 Tax Act, I'm going to come up with it so that next week I'll give you the salient provisions which you then have to use as you are advising these notes. So these are the notes, taxation notes by Mr. Mpatsi. Now, coming back to my program of study, are you noticing that taxation syllabus is very short? This is the program of study, and you can see there is no time for us to waste. So right away, let us discuss gross income here. So I have given you the notes. I'm going to send the 2020 provisions concerning VAT, 2020 provisions concerning Capital Gains Tax Act. Once I've done that, to a large extent, your notes are now complete. Don't use the figures in those notes for these two topics because they are no longer relevant. But the theoretical stuff, you can still go ahead and read it. But it will be until we get here. So for now, it's not even relevant. But by next week, I'm going to send it to the class. So let us get things started. Gross income. Gross income. This is our first topic. Sorry, gross income. You know what? Principles concerning taxation, it boils down to, do you really know what your income is? And do you really know what are your deductions or expenses, such that you pay tax on the profit or on taxable income? That is the basic of taxation. You need to know what constitutes income and what constitutes expenses, so that if you say income minus expenses or deductions, that's the proper terminology to use, you'll be left with what is then taxable. So the syllabus then hangs around us or myself teaching you what really do we mean by income, such that you don't run the risk of not including income which must be included, or over including income, meaning incorporating some incomes which are not considered incomes for tax purposes. That's gross income. That's the starting point. That's the start. So I'm sure you are jotting down this. Remember, this video will be streamed anyway. Still fine. We will stream the video to my YouTube. Make sure once I share the link, that becomes a permanent copy of the video, and you can then play it for subsequent slots. Why we don't have taxation Zim on Atlan's first intuition learning platform? It's because Zim variant cannot be, because it can't be accommodated. That one is a global standard platform. So clearly Zim variant is a localized tax regime. So we have to do it ourselves. But when it comes to UK tax, it's there on the platform. Reason is the platform is from UK. So naturally you'd expect UK tax to be there. No wonder why we have UK tax on the platform, but we don't have Zim tax on the platform. So it's still fine. If you are doing UK tax, we have already populated videos on the platform. If you are doing Zim tax, which is compatible with our local environment, which you can immediately give hands-on to you can demonstrate knowledge to your employers by Zim tax. UK tax, well, it's fine, but you need to now convert it. How you can now demonstrate it if you are working in Zim, it becomes an issue. But Zim tax then becomes more robust. They are both still ACCA subjects, so it's still fine. Now, what do you understand by gross income? That's a question which is to be answered. So here is the definition of gross income. It's Section 8 of Income Tax Act. Though we don't necessarily want to ask you the relevant section of the act, but if you are working at work, you do notice it's Section 8, Paragraph 1, though not necessarily examinable, but you may need, because you may be tax consultants very soon. So you need to know from which section of the Act am I getting this. So Income Tax Act Section 8, Paragraph 1 defines gross income. It defines or brings the section brings into gross income. The section brings into gross income all amounts received by the taxpayer, received by the taxpayer, received by the taxpayer, received by the taxpayer in the year of assessment, except to the extent to which the amount is of capital nature. You get that? Is of capital nature. So that's the definition of gross income. All amounts that you receive, if you being a taxpayer in the year of assessment, except to the extent to which the amount is of capital nature. So if you receive income which is of capital nature, that one is outside the definition of gross income. So we can then say the following are amounts of capital nature. The following are amounts of capital nature. The amounts of capital nature that if you receive those, we don't consider them to be income. If you receive these amounts, We don't say you have received income. They include lottery win. You know, lottery win. If you win lottery, it's an amount of capital nature, meaning it is outside the scope of income. 2, another amount of capital nature is inheritance. Inheritance. Now, Rumbi, what do you understand by inheritance?
Inheritance is any amount of money that maybe my parents would have left for me in the event that maybe they've deceased.
Yes. So clearly we can't expect the commissioner to again say I need my share as well in the form of tax on inheritance. You get it? Another it's proceeds on disposals of non-current assets. If you sell non-current assets, what you get, it's a capital receipt. It's an amount of capital nature. So it's outside outside the definition of gross income. Now, you know, this definition which we have here, it's a very, very important definition. It has got a lot of words. It has got this word here, amount. Let me highlight it. And then it is the word taxpayer. Taxpayer, we need to find out to actually define who are these. It has got year of assessment. Year of assessment. All right. So let us proceed with this in our delineation of this particular definition. So let us now take a close look at definition of gross income. Definition of gross income. That definition, let us now take a closer look and proceed with it. Let us now talk of amount. What really do we understand by amount? If we say income means amount, there is need for us to define what amount is. You know, it's not like every amount means money. No, money is an amount, but if we say you are taxed only when you receive money, then it means those who haven't received anything, then they won't be taxed. So amount means money or any. Let me define it. Say it means money or any incorporeal, corporeal or corporeal property which has an ascertainable monetary value. This one is so important. Amount does not necessarily mean money. It means money or anything which we can attach a monetary value to, e.g. fringe benefits. You know, we shall discuss fringe benefits shortly. We shall discussed shortly, or let's say discussed later. We shall discuss fringe benefits shortly, but you know that when you are using a company vehicle, actually you are getting income from the use of that company vehicle, but that income is not in the form of money. So amount does not necessarily mean money. So the commissioner can actually come up with the it can ascertain the monetary value for the use of a company vehicle. I shall teach you how shortly. Then still on amount, the amount must be due or payable, must be due and payable to the taxpayer. Payable to the taxpayer. The amount must be due and payable to the taxpayer. You get that? And must be for the taxpayer's benefit. Taxpayer's benefit. Meaning, if you are a property consultant, for example, you manage properties and you collect rent on behalf of property owners. Clearly, the rent that you collect, you can't call that amount. Why? Because it's not for your benefit. So it doesn't come under gross income. Are you getting that? So we want to get these definitions one by. Another thing is it must be due and payable to the taxpayer. Meaning we don't necessarily tax future income. We tax income which is due and payable. All right? Now, 2 year of assessment. Year of assessment. That's, I'm sure this is another aspect that we have to look at. What do we mean by year of assessment? Year of assessment doesn't necessarily just mean 12 months. No. It means 12 months from the 1st of January. Each year. That's the year of assessment. Meaning, if you start your business in October, you are taxed for 3 months of the year because it's October, November, December. That becomes your year of assessment. From January to September, it will be 0, and you commence your business in September. You now understand that? All right. Normally, okay. Or you are taking the screenshots of. You are taking screenshots of the chat. You know, these you guys are stars. These are like interactive plugins that you can use. So, what have we defined here? We have defined year of assessment. You now understand what year of assessment is. So normally you are, let's say, a taxpayer is said, you know, in June we had a student who got something like 87% in taxation for Zim. So it means, as for you guys, that's the benchmark we want to hit, and make sure you surpass that. A taxpayer is said to be a resident in Zimbabwe. If he or she spends at least 183 days in Zim in any year of assessment. In any year of assessment. So important. For us to say you are a Zimbabwean resident taxpayer, you must have spent at least 183 days in Zim for any given year of assessment. Now, the obvious question then which follows is, say, what about ambassadors? Suppose an ambassador is appointed to be a Zim ambassador to South Africa and spends 5 years there. So does it mean this person is no longer a resident of Zimbabwe? You know, if you are outside the country solely for state duties, e.g. as an ambassador, you are also deemed to be a resident in Zim. So we can say for those outside the country solely to render services to the state, e.g. ambassadors, you know, ambassadors. If you are an ambassador, if you are outside the country solely to render services to the state, they are deemed to be resident in Zim. They are deemed to be residents of Zim. You shall notice, why do we say they are deemed to be residents of Zim? Because we need to know the source of income. The source of income. So, right? So we are saying, you know, the definition of gross income, once again, it says, this section brings into gross income all amount received by the taxpayer in the year of assessment, except to the extent to which the amount is of capital nature. There is another point that we want to emphasize here, which is called the source of income. Source of income, which is number 3. Source of income. Please, you are already learning. Don't say today we are just doing introduction and then we shall start to be serious later. No. Those who know your say, you are already into it. We are already geared deep. You are already moving. The source of income. You know, it's not like every amount should be included in gross income by virtue of it having been received. It depends on the source of that income. Right. So it's important. So let me first define a source. A source is the originating cause of income. Source is the originating cause of income. You know, that's the source. It's an originating cause of income. And you know, that which gave rise to you being entitled to the money is what we call the source. So for income to be included in gross income, the source must be, so let me repeat and say, for an amount included in gross income, to be included in gross income, the source must be located in Zimbabwe. The source must be located in Zimbabwe or deemed to be from Zimbabwe, or deemed to be from Zimbabwe in the year of assessment. Year of assessment. This is a very, very important point. For us to say this is gross income, the source of that income must be located in Zimbabwe or deemed to be from Zimbabwe. Now, there are two words here. If there is issue of located in Zimbabwe, there's an element of deemed to be from Zimbabwe in any year of assessment. You get that? In any year of assessment. What do we mean by deemed to be from Zimbabwe? Now, if you are asked, what are we doing? We are taking a closer look at the definition of gross income. When I said, it said amounts received. It doesn't necessarily mean everything that you receive. No. We are now taking a closer look by these discussions. Like, if you receive an amount, what was its source for it to be included in gross income? It's so important. So let us have like examples of sources of income. Examples of sources of income. I know we are moving. And we are moving at a pace that I like. Examples of sources of income. Like, so let us have a rent from immovable property. Here is a person who is renting a house. We are renting out a building, meaning you are receiving the rent. Now we want to know, whenever you receive rent from a property which is immovable, and yet you are in Zimbabwe, does it automatically mean that the Zimbabwe government will tax you? It depends on the source of that rate, of that income. So here it's like the source is located. The source is located where the property is situated. You know, the source is located where the property is situated. That one is a very, very easy point. Rent from immovable property. So if you are receiving rent, so for example, e.g., rent from a cottage in Botswana, rent from a holiday resort in Botswana is not from Zimbabwean source. From a holiday resort in Botswana is not from Zimbabwean source. So if you have rent from a holiday resort in Botswana, clearly that rent is not from Zimbabwean source. Get that? Why is it not from Zimbabwean source? Because the property is situated in Botswana. So you can't include rent from a holiday resort in Botswana when you are taxing Zim income. Simple as that. B, rent from movable property. Now, property can be immovable or movable, as you can see from what we've just done here. Now, the question now is, we do have companies like those car rental firms, which list their cars to various destinations, regionally or locally. Suppose there is Avis car rental. It rents out its cars, whether in Zimbabwe or regionally to Zambia, South Africa and stuff. So if it receives money for renting that car out, does Zimbabwe government tax that money if the car was used in Zambia? That is now the issue. You know, we said if the property is in Zambia and you receive rent, that rent is not from Zim source. But what if Avis car rental rents out its car to Zambia? What if we now have such a situation? How do we proceed? So what you simply have to do is, under the circumstances, you say the source is located in a country where the taxpayer's business is registered. Taxpayer's business is registered. You can see now that this is done for administrative convenience. We can't have a situation where you are doing reconciliations similar to say, oh, the fraction of this journey or this mileage for the car was in Zambia, the other was in Botswana, and the rest in Zim. So can we apportion the rent accordingly? It's administratively inconveniencing if you want to go it that way. No wonder then we say, we don't care where the car was hired. What we care is where the taxpayer's business is registered. That's where tax is paid. And C, royalties. Royalties are monies that you get paid for novelty. You get paid for novelty, like what artists get. They get paid royalties. You get that? Now my question now is, if you know that artists, they get paid, musicians and stuff, when their music or their art is being played on whatever platform, normally they get paid something for each unit which is played. Now the question now is, where does how then does the Zim government take such? Let's say Japanese is earning royalties from music being played in South Africa on SABC. Music is being played in South Africa, and Japanese is in Zimbabwe is earning the royalties. Does Zim government then takes that royalty? That's the question we want to answer. That do we put that royalty in gross income, so to speak? Or alternatively, let us put it the other way and say, you publish a book whilst you are studying like masters at UZ. You wrote the manuscript for a book, and then the book is then published in Australia. And when the publisher in Australia is now selling copies of your book, there is a royalty that you should get. Now that you are in Zim, does Zim government takes that particular royalty? Are you not seeing the puzzle there? How would you solve that puzzle? Do you suggest that Zim government should tax the royalty? Tendai, talk to yourself. Yes. Who else? If Tendai is not hearing me. Yes, who else is in the class? AP, talk to yourself. Do you suggest that Zim government should take the royalty where you publish, you wrote a book, a manuscript at UZ, and then you secured a publisher in Australia, and now as the book is being sold in Australia, you are getting the royalties. You are here in Zim. So the question is, do you think Zim government should tax you?
All right. Unfortunately, I don't know whether it's my network or it's on your side. I keep missing bits of your explanations there, but I would think for a book, perhaps the source is where the book was published.
Okay. Well, if you are missing bits of explanations, don't worry. The lecture is being recorded, as you can see on the top left-hand corner. So you get a video link when we stream this lecture on YouTube. So you can still play it at your own leisure, and it will smoothen out all these intermittent network connections. You won't have these when you're playing it on YouTube.
Thank you.
Okay, so your suggestion was the source is where the book was published. Tendai, do you have a variant of it? Okay, let me take it up. When you have such a puzzle, the source is not necessarily where the book was published. Rather, the source is where the author's intellect was exercised. You know, so it's like this. The source is located where the author's labor and intellect was exercised. That's it. So in the case of writing a manuscript for a book, whether the book was published in Australia, that's not where the intellect was exercised. The intellect was exercised when someone was writing the manuscript for the book, and this manuscript was written whilst the person was studying at UZ. So the source is located in Zimbabwe. So no wonder, so even if you are composing a music, you compose a music in Zim, and then a music is being played on channel O. You know, the source is where you exercised your labor and intellect, your wits and your knowledge. If you exercised it in Zim, it's income from Zimbabwe, regardless of whether this music is being played on channel O stuff. So when you are getting royalties from there, they are taxed in Zim. So if you publish a book in Zim, but you wrote the book whilst you were in UK, it means you exercised your intellect in UK, not in Zim. So such royalties are not to be included in Zimbabwean gross income. D, let's say dividends. You know, clearly dividends is another issue. So the source for dividends is the investment in shares. The source is the investment in shares, and is located where the shares are registered. Is located where the shares are registered. So if in South Africa and you get dividends, the source is located in South Africa because the shares are registered in South Africa. But there is another issue now. You know, if Zim government is to allow that to happen, there's a danger that people will now have a habit of investing outside. Suppose you realize that, oh, in Botswana there are lower taxes, so you go to Botswana and invest in Botswana, and then you get dividends. So under the circumstances, investors will begin to take money out. So to mitigate that, there are taxation principles, then they are codified in that regard. Let's say, however, dividends, let's say, let me put it like foreign incumbent dividends received by resident taxpayers, received by Zim resident taxpayers is subject, or let me just say is taxed at 20%. Now you understand now why is it we have to tax foreign incumbent dividends like this? The reason is we can't have a situation where you are resident in Zimbabwe and you are busy investing in South Africa, only for you to get dividends, and Zim government doesn't tax you because the source is where the shares are registered. So to mitigate that, we run the risk of not getting any money as government. So no wonder why then we then have to tax foreign incumbent dividends. You know, what are we saying for those? If suppose you are to play this video from this juncture, we are defining gross income, and we said it includes all amounts that you receive as a taxpayer in the year of assessment, except to the extent to which these amounts is of capital nature. That one is important. Then we are delimiting the definition, especially when we say received by. We said there's need to know the source of that income. And for the operation of the Tax Act, Income Tax Act, the source must be located in Zimbabwe or deemed to be from Zimbabwe. Why is it there is located in Zimbabwe or deemed to be from Zimbabwe? It's because deemed means it might not be in Zimbabwe per se, but by the operation of the law, we deem it to be in Zimbabwe. So continuing, income from services rendered. Income from services rendered. You know, like what we do here, we get wages, salaries. We get wages, salaries. What else? Tips, bonus, etc. All this we get as we render services. So no wonder why we call it income from services rendered. So how is this taxed? Because you may render a service for an NGO, you get paid from America. You are an accountant at an NGO and you get paid from America. So does the government then fail to tax you because your money is coming from, say, America? No. What happens is the source is located where services are rendered. The source located where the services are rendered. Where the services are rendered. That is important. The source is located where the services are rendered. So if you are working for an NGO in Zimbabwe and you are being paid money from Europe, we don't consider where the money is coming from, but we consider where the services are rendered. Sorry, what? Just a minute, guys. Let me answer this call. Hello. Okay. Gosh, that's here. All right, it's okay. Sharp. So we are saying the source is located where the services are rendered. So for that. So you get that. So we said the source is located where the services are rendered. But remember what I said just before. I said, if you are an ambassador and you are working in South Africa, and this is saying the source is located where services are rendered, you can sense the contradiction there. So what is required is, if you are outside this country, so we can simply say, if you are outside the country solely for rendering services to the state, like an ambassador, even if you are rendering these services outside the country, the source is deemed to be from Zimbabwe. You get that? The source is deemed to be from Zimbabwe. Another issue for temporary absence.
Sorry, sir.
Yes. Yes.
Right. Like you are saying, there appears to be some inconsistencies there that may actually lead to confusion to some of us who are not versed in this accounting language. When you explained the source, the concept of source there, I thought that was quite clear to say we should actually be taxing income that has a source located within Zimbabwe, or that is deemed to be within Zimbabwe. But it appears as if dividends there, for example, is breaking that concept, And you explained that perhaps the idea is to try and discourage resident Zimbabweans from investing outside Zimbabwe. But then,
yes,
I feel that indeed that is a break of that concept of source, and this income from services rendered as well. The example that you gave about an ambassador, if you are saying the source is located where the service is rendered, now if an ambassador rendered a service, is the ambassador rendering service to, for example, if it's say it's a Zimbabwe ambassador to South Africa,
yes.
is the service they render to South Africa or to Zimbabwe?
By going by the phrase where, if we go by this phrase which is saying where, it's referring to a place. In this case, they are rendering a service to South Africa. That's where they are rendering the service.
Okay.
But I then no wonder
that
why
is
I was
another
now,
break from that concept of source as well.
Exactly. Exactly. No wonder why I was now explaining it further by these coming sentences. Clearly, the reason why we explain further is to acknowledge the break from the standard definition of source.
All right. That's
Yes.
fine. Thank you.
You're welcome. Even if you look on dividends, I said, however. By saying, however, I'm acknowledging a clear break from the conventional treatment of source. That's the meaning of these words. So you say you earn wages, and the source is where the wages or the services are rendered. But now, for temporary absence, that's where I was. Let me proceed now. Thanks for the question. For temporary absence, what do we mean by temporary absence? Meaning being outside Zim, for 182 days or less in the year of assessment, being outside Zim for 182 days or less in the year of assessment, then income is to be from Zim source. So if you go to South Africa for 2 months and you work there, if you go to South Africa for 2 months, you work there and earn salary. Because you have not exceeded 180, it means you are deemed to be a Zim resident, even though you are in South. Because its income is deemed to be from Zimbabwe by virtue of residence, even if you are away. But because you are still within the definition of a resident taxpayer. Remember, we defined the residence here as a taxpayer is said to be resident if he spends at least 183 days in Zimbabwe in any year of assessment. So if you spend 2 months in South Africa and the rest of the year in Zimbabwe, the income you have earned in South Africa for those 2 months is deemed to be from Zim source. Now you may say, that does it mean I have to declare it? Yes. Now you can say, what if in South Africa I was taxed? The government is still continue to tax me? Yes. But you can claim what is called double taxation relief. There is what is called double taxation relief, which is an acknowledgement that this income was taxed also in South Africa, so we can't overburden again. Let us deduct the South Africa portion of tax from the Zim tax due. That you can elect to claim that. AP. I mean, grasp the name AP. Don't worry, it's just saying AP. As you can see, pretty soon I will know what AP is. I'm sure again AP.
That's Adam Pavlis, eh?
Adam, perfect. Okay, so there you go, Adam. So you have to memorize what I've said just now, that if you are now outside, even if you are outside the country, like an ambassador per se, who really spends more than 183 days outside, it doesn't mean he's no longer a resident, because he's outside solely for the purpose of rendering services to the state. What you have also noticed that a tip is income. So if someone is a till operator, and is a waiter, and you are being given tips, these are also incomes. They are don't just say it was a tip and you pocket it without declaring it. It's income, and the commissioner has the share. Okay, so these were like just common examples of gross income. The list is endless, because there are quite a lot of incomes that you can get. You can say income from trade. You are into buying and selling of goods or services. You know that the source is located where the business is registered. You are here in Zimbabwe, and I'm teaching someone. Clearly, I can't say, the student is from South Africa, so in Zimbabwe. So the source is located where the business is registered, if you are into buying and selling. Now, there are complicated cases where you register in Zimbabwe with a partner who is from Mozambique, and then that partner buys from South Africa and sell to Europe. There are some decided cases, like case laws, to determine the source of that. There is an arbitrary determination of where the source is. Actually, there's a need for that. No wonder why we now have advanced tax, which you do as an optional subject, if so choose, at a strategic level. But for now, we keep things simple. Okay, now let us now have, what we were doing was close gross income. I like it. It was just close look at the definition of gross income. You now understand it well now. It's no longer an issue of saying it's all amounts received by the taxpayer in the year of assessment, except to the extent that the amounts which are of capital nature. No, you can now say this section, which is section 8.1, this section brings into gross income all amounts received by the taxpayer from sources in Zimbabwe or deemed to be in Zimbabwe in the year of assessment, except to the extent to which such amount. We are now improving on our definition. Now, specific aspects of gross income. Specific aspects of gross income. Specific aspects of gross income. You get that? Remember, the first discussion item is gross income. So that everything is just saying gross income, because that is our first chapter. So the specific aspects of gross income. Let us now have the one by one. Annuities. What an annuity, you may ask? Because we are saying gross income is amount that you receive. Let us now go amount by amount in some of the specific aspects which are commonly examinable. So let us start by annuities. Get that? So because we are saying gross income, remember these are not payments, they are incomes. So you are receiving an income which is called an annuity. So an annuity, what is it? It's basically a regular fixed fixed income, regular fixed income, paid each year, regular fixed income paid each year for a given period of time. That's an annuity. Just a sec. So sorry for that. So what is it that I was saying? I was saying an annuity is a regular fixed income paid each year for a given period of time. That's an annuity. Definition is important. So e.g., you may say you are paid 5,000 per year or per month for 10 years. That's an annuity. It's a regular fixed income which is paid each year or each period. It might not be per year or even per month for 10 years for a given period of time. So these are annuities. Now let us see the different types of annuities that we have. We do have what is called purchased annuities. Purchased annuities. Right. For you to understand what a purchased annuity is, let me give you a common example. You know, companies like Old Mutual or most insurance companies, they have got packages, you know. They have got packages where they can say, they've got packages where they can say, can you pay 2,000 US now, such that after 15 years from now, you'll be entitled to 1,000 US per annum for 8 years. So the 2,000 you pay today is called the purchase price of the annuity. It's called the purchase price of the annuity. Now, the 1,000 that you shall get after 15 years from now, every year for 8 years, that is now the annuity. So we do have two cases in point. Let me say case A. Case A is like this. Let's say your salary is, these are US, remember. Your salary is 12,000. Your salary, 12,000. And then the commissioner says, deduct purchase price of annuity, to say purchase price of annuity. If you deduct the purchase price of the annuity, which is 2,000, what it means, I'm sure you are paying attention. What it means is you are then taxed on 10,000. You are then taxed on 10,000. This is case A. Let me have case B. Let me have case B. Now, on case B, it's slightly different. Here's the situation on case B. On case B, it's like salary is 12,000. There is no purchase. You are not allowed to deduct the purchase price of the annuity. So you are taxed on 12,000. And then after being taxed, you then pay 2,000 from your net salary. So if you go by case, suppose you go by case, sorry, I said this is case B. If you go by case A, pay attention. If you go by case A, what is presented on case A is like this. It means the commissioner allowed you to deduct 2,000 before you pay before you pay tax. The tax was then charged on 10,000. So when you are now receiving 1,000 after 15 years, it means the 1,000 must be taxed in full. Why is it must be taxed in full? Because when you purchased it, you were allowed to deduct the purchase price, meaning the purchase price was not taxed. You were allowed to remove purchase price from income, and then you were taxed on the balance. So when you are receiving the 1,000 15 years from now, it must be taxed in full. Now, if you go by case B, notice, case B, the 2,000 was not allowed as a deduction. In other words, you paid tax on 12,000. So if you are now receiving 1,000 after 15 years, we don't tax 1,000 in full because the purchase price was taxed when you purchase it, because the purchase price is still in 12,000. So we then tax only the interest component on that 1,000, not the full 1,000. So this is what these are the points that I want to highlight. So it's like this. Let me delete. Let me undo it. Right. Okay. Purchased annuity. So the first point is, if a taxpayer purchases an annuity, and the purchase price was not allowed as a deduction at the point of purchase. This is case B. If the purchase price was not allowed as a deduction at the point of purchase, then only the interest portion of the annuity is taxed. Only interest portion of the annuity is taxed. You will only tax the interest component of the annuity. Full stop. So the interest portion is calculated as follows. Are you not seeing how I like typing? Can you imagine? Your exam is now computer-based exam, so you have to teach yourself to type. How do you teach yourself? Can you imagine, as you say, I could have been saying all this without typing. So you may ask, why is it say you like typing? It's because I want you to emulate me, to be fond of typing, knowing perfectly well that your exam is computer-based. It means you have to try to be speedy on typing from day one. So I am trying to do this to inspire you. And are you not seeing how legible and how clearly presented my points are? So should be your points also when you are answering taxation exams, because you are like a tax consultant. You should present things in such a manner that the audience would actually get understanding. So how do you calculate the interest component of the annuity? So you say interest component, which we can denote as I, equals. So that's how you say P times N, P times N minus A, then over N, P times N minus A over N. That's how we calculate the interest component of the annuity. the interest. Remember, I gave you the notes already. Taxation notes by Mr. Mpatsi. They are accessible in our WhatsApp class group here. So you can as well, oh, Tenda is saying electricity is out. Well, still fine. The lecture is being recorded. Whenever electricity is out, don't worry. You will still play the recording, so it's not a train smash. So after doing this, you then say where you then say P. P is the annual payment. Annual, that's the annuity, the amount you are going to receive, annual payment received. And then N is the number of annual payments, is the number of annual payments, and A is the purchase price of the annuity, purchase price of the annuity, and A is the, then, so you have that. A is the purchase price of the annuity. So this is how you calculate the interest component. And this formula is only used when the purchase price was not allowed as a deduction. Was not allowed as a deduction at the point of purchase. That's only you use this particular formula. When the commissioner did not allow you to deduct the purchase price from income before getting yourself taxed. All right. Then, if the purchase price was allowed as a deduction, if the purchase price,
just a question.
Yes.
Is it always that the payments are annual? If they are not always annual, does the formula change? Say,
you are asking a very good question. If the payments are not always annual, you convert it into annual. So suppose you are given 1,000 per month. It means it's 12,000 per year. You get that? So instead of putting 1,000, you'll be putting 12,000.
All right.
If the purchase price, okay, you're welcome. If the purchase price was allowed, as a deduction, comma, then only the interest portion of the annuity. If the purchase price was allowed as a deduction, then the annuity is taxed in full. Right. On this one, let me give you an example, because it requires illustration. Such a question requires illustration. Though you see quite a lot of illustrations in the notes that I've just sent there. There are quite a lot of them. So, okay, sorry, I'm seeing something. Tendai, you're back. Welcome you. Okay, don't worry, the lecture is being recorded, and this way, if you play the recording, it smoothens out all these intermittent network challenges, because the person who is recording is me, Yose, and as you say, I don't have any of these issues, because as you say, as expected, I am shielded from all this. Okay, so illustration. Let's say Mr. X. Mr. X. Mr. X purchased an annuity. Mr. X purchased an annuity many years ago. Many years ago, he purchased it for 12,000. USD. If you are given dollar, still fine, still the same. Mr. X purchased an annuity many years ago for 12,000 USD. On 1 October 2020, you now know our tax year is 2020. On 1 October 2020, he became entitled to a monthly annuity of 800 USD, 800 USD or 800 USD for the next 10 years. Given that the purchase price was not allowed as a deduction, determine Mr. X gross income. Determine the amount to be included in Mr. X gross income. For year ended 31 December 2020. I'm just trying to show you how the questions may come like this. So this might be a multiple choice question. A simple question like this, it might be a multiple choice question. So here, you are told that the purchase price was not allowed as a deduction. So what we do? We tax the interest portion. So only the interest portion is taxable. So what it means is we bring the interest portion here like this, because the purchase price was not allowed as a deduction. So what does that mean? P is the annual payment. It's so important that he is receiving monthly annuity of 8,000. So P becomes 800 times 12. So P becomes 9,600. This is the annual payment, USD. N is the number of, so are you not, we were given monthly payment, because in our formula, P is not a monthly payment, but it's an annual payment. We have to change it to an annual payment. And then here, N is the number of annual payments, and the number of annual payments is, in this case, is 10. And then A is the purchase price of the annuity. In this case, the annuity was purchased for 12,000. Right. Okay, so there you go. Now, so you can now say interest equals we only put interest here. So it's now 9,600 times 10 close bracket minus 12,000, then everything there divide by 10. Are you not seeing? First solve the numerator before you divide by 10. I can't find my calculator with me. I'm sure my children have taken it from my start room. So I can now make use of the Excel functionalities that I have here. So you can see here that you say equals, this becomes 96,000 like this, equals, let me open bracket, 9.6 by 10 is 96,000 minus 12,000, close bracket, over 10. This is annual interest per year. So this now is annual interest per year. Under normal circumstances, this answer will be at option A if it's multiple choice. But you can see now that this answer is wrong because this is annual interest per year. But he started receiving on 1 October 2020. So for 2020, we then have to time apportion that by 3/12 because it was October, November, December only. So you say for the year 2020, comma, annual interest is time apportioned to 3 months. 3 months. Why 3 months? Because it's October to December. Time apportioned to 3 months. So which will be equals, we are now saying 8,400. 8,400 multiplied by 3/12. That's 700 times 3, which is equals to 2,100. 2,100 USD. So this is the amount to be included in gross income. This is the answer. This is the answer. Are you getting it? So it's so what is important is to pay attention to detail. Make sure you pay attention to detail. All right. So there you go. So we were discussing purchased annuities, and I gave you an example of purchased annuity. I gave you an example that you can relate. I said like policies that we purchase from Old Mutual, where they say pay so much, so that as you get up to such a time, you'll be entitled to an annuity, meaning a regular payment of so much, be it per annum or per what. So that would be the case. And then next is annuity for services rendered. It is no longer a purchased annuity, but it's an annuity for services rendered. Annuity for services rendered. What does this mean? It means, e.g., pension. When you retire, you get pension, and pension is a regular payment again, because it's a regular fixed payment, meaning it perfectly meets the definition of an annuity. So annuity for services rendered, like a pension, the answer there is the annuity is taxed in full. The annuity is taxed in full. That's the annuity for services rendered. It is taxed in full. However, old age pension received is exempt from tax. Exempt from tax. You know, there is, pension which is being paid to these elderly people, it's exempt from tax. Anyone can be paid pension. You need not to be an elderly person to get paid. So don't say, because I am receiving pension, it's exempt. It depends. Are you an older? Are you an elder? So who is an elder? Let us define it. An elderly taxpayer is the one who is 55 years and above. That's an elderly taxpayer. So when you are saying old age age pension, we are referring to a person of this age. We are not just referring to any elderly person. If you are 55 years and above and you get pension, whether even all the provisions of whether it was a purchased annuity or not, all this, as long as you are above 55, it's exempt. So you know, the elderly provision, the exempt elderly annuity provision also applies to purchased annuities. So even if you purchase an annuity, whether it was allowed as a deduction or not, if you receive, like what we have done here, where we said Mr. X here, if Mr. X was 60 years, every annuity that Mr. X gets is exempt on this part, whether purchased or it was a pension or what. So that's the point there. You don't even calculate interest or do. When we say it's an exempt, it means there's nothing that you do. For tax, consider zero. That's what it means. What are we doing? We are discussing specific aspects of gross income. So we are still on annuities. Then number 3, annuities by gift or legacy. Annuity by gift or legacy. You know, annuity by gift or legacy, it's like if I'm the one who was Mr. X here, if I'm Mr. X here, then I decide to give you my annuity. You know, Mr. X is the one who purchased it, and then I then just decide to give you the annuity as a gift. Or I die and you get the annuity as a legacy. Clearly, you can't then say, I only need to be taxed the interest portion because Mr. X purchase price was not allowed as a deduction. You know, the annuity, you were just given the annuity as a gift. So that issue of saying purchase price was not allowed as a deduction doesn't apply to you because you didn't purchase it. You were given the annuity as a gift. So what it therefore entails is here, if we say annuity by gift or legacy, we simply say the annuity is taxed in full. Taxed in full, whether or not the purchase price was allowed as a deduction. The purchase price was allowed as a deduction. That's annuity by way of gift or legacy. This one is taxed in full, whether the purchase price was allowed as a deduction or not. These are specific aspects of gross income. We have done annuities. Now let us look at fringe benefits. Fringe benefits. That's specific aspect number 2B. Fringe benefits. Fringe benefits. You know, you need to understand that at work we get what we call fringe benefits, meaning benefits which accrue to you as an employee from this employment that we have with your employer. Call these benefits. So if you what is a fringe benefit? It's a benefit accruing to an employee. Benefit accruing to an employee as a result of employment contract. So this is important. If you are just suppose you are an electrician and we hire you to fix our electricity and we give you a company car, that doesn't mean you are now you're getting fringe benefits because you are an independent contractor. For you to use the word fringe benefits, there must be an employment relationship. That is the key. An employment relationship must exist. An employment relationship must exist. How do you tell that this is an employment? You know, there are various ways to tell that this is a relationship. There should be a letter of employment. Let's say there should be contract of employment. You know, there should be a contract of employment, code of conduct, statutory deductions. It is employee doesn't, you know, for you to know that this is a contract of employment, an employee doesn't bill. It doesn't bill the employer. This tells you that this is a contract of employment. You know, you don't just say at the end of every day, do you bill your employer? To say at the end of every day, boss, here is my invoice. Come tomorrow, boss, here is my invoice. When you are doing that, you are not an employee. You are what we refer to as independent contractor. You are what we refer to as an independent contractor. If it's not, so this is a key thing that you have to commit to memory. To see if it's not an employment contract, if it's not an employment contract, the relationship is that of an independent contractor. Independent contractor. You know, if you are an independent contractor, it's like you raise invoices are raised for each work. Invoices raised for each work done. You raise invoices for each work done, and you are also not bound by employer's code of conduct. By employer's code of conduct. When you are not bound by an employer's code of conduct, like you come at a time where you feel fit, you don't have a dress code, you don't have even, you know, what we call the code of conduct. There's no letter of it, but a contract of employment. But for each week you do, you bill the employer. So it means there is an independent contractor. Now, for independent contractor, we don't talk of fringe. There are no fringe benefits there. Is that if you are an independent contractor and we give you a company car, don't say I am enjoying fringe benefits because you are not an employee. Fringe benefits, they only apply in where there's an employment relationship. So you now appreciate the difference between the two, independent contractor and an employment relationship. Fringe benefits are only relevant when there's employment relationship. Now, taking fringe benefits, remember, fringe benefits are forms of income. No wonder why we say these are specific aspects of gross income, meaning they are actually forms of income, fringe benefits. So let us talk about how are they valued, like valuation of fringe benefits. Valuation of fringe benefits. Here's how you value fringe benefits. right? You are learning quite a lot. Valuation of a fringe benefits, general rule. So there is general rule. This is the general rule for the valuation, though there are particular rules for the valuation. So the general rule is, in general, so you can say, in general, comma, fringe benefits are valued by a reference to the cost incurred by the employer. The cost incurred by the employer. What does that mean? It means cost to the employer. Cost to the employer is a benefit in the hands of the employee. Cost to, if your employee buys you, say, groceries, and the groceries cost 22,000, it means the benefit to you is 22,000. The cost which is incurred by the employer is the benefit in the hands of the employee. You get that? Now, particular valuation guidelines. Particular valuation guidelines. We are saying deviations from general. What are the deviations from the general rule? These are now particular valuation guidelines for fringe benefits. Right. Okay. Now let us see how certain benefits they deviate from the general rule. Let's say use of company house. Use of company house. Suppose you are using the company house for the employee, or of the employer. Use of company house. Use of company house. Whenever you are using company house as a fringe benefit, the employer builds a house for you. The valuation is easy. The issue is if the house is located in a municipal area, if the house is located in a municipal area, comma, the benefit to the employee, the fair market rental of the house foregone by the employer. Fair market rental of the house foregone by the employer. The fair market rental of the house foregone by the employer. That's a benefit. Another is if the employee pays rent below the fair market, then the difference is the benefit, is the fringe benefit. So you get that? Suppose you pay rent, the fair market rental is 2,000 and you are paying 1.8. The 200 is the benefit. You get that? That's the use of company house for a house which is located in a municipal area. What is a municipal area? An area which belongs to a local authority. like Sito Ferrari, Sito or Norton Town Council, you know, an area where we can tell that there is a market rental for the house. So if the market rental for the house is 500 and you are paying 200, 300 is the benefit. If you are not paying anything, the entire 500 is the benefit. You get that? That is for a house which is in a municipal area. Then, if the house is located, outside the municipal area, you know, there are instances when the house is located outside the municipal area, like a house which is in Dombosha, that is outside a municipal area because it's a district or something. It's not a, these are rural areas. If the house is located outside the municipal area, then the benefit to the employee is the lower of, meaning when we say lower of, meaning you compare the two and take the lower. That's what it means. It is the lower of, always not, I'm saying lower of 1, 12.5% of salary, 12.5% of salary. If you want annual benefits, it will be annual salary. If you want monthly benefit, it will be monthly salary. Or you can calculate the annual benefit and then divide it by 12 to get monthly. Or and 2 is 7% of the cost of the house. So if we have a situation where the house is outside the municipal area, you need these two pieces of information to calculate the benefit. You calculate 12.5% of salary or 7% of the cost of the house and take the higher figure. I don't think that should be an issue. 12%, 12.5% of salary and take the higher figure. Now, pay attention to the point that I want to say now because it's very, very important. It's like this. This particular point goes like this. There are instances, you know, where the person in question is just a bachelor. Suppose you're a bachelor and you just need one ensuite. Just one ensuite, perhaps with a kitchen. That is if you cook at all. Or you may just need one ensuite. But the employer has built 16 rooms, 11-roomed house, 5 beds house. But of the 5-bed house, you are just using one ensuite. So even if the fair market rental of the house is, let's say, 5,000 or 2,000, clearly you are not benefiting from 11 rooms if you are a bachelor staying there. You just need one ensuite. So there are instances where, whether it's in a municipal area or it's in a non-municipal area, the benefit is restricted to the value reasonably being received by the employee. What does that mean? It means if the employee feels, imagine, suppose I'm a bachelor, and the employer constructs a house for me which is 11 rooms, and I'm just using one. Clearly, the employer can't say, because the fair market rental that I'm foregoing is 2,000, so the benefit to you is 2,000. Yet I'm using one ensuite. So what then is the benefit to me? It's what I'm reasonably getting, regardless of the fair market rental. This is the point I want you to say. Even regardless of the cost of the house. Suppose an employer then built a house for 1 million at Dombosha, and then the employer says 7% of the cost of the house is your benefit. If I'm just using one ensuite of that house. So this is NB, point to note. It's like the housing benefit is restricted value being reasonably received by the employee. Are you getting it? This is important. The housing benefit is restricted to the value, meaning the employee must tell us how much is the employee reasonably getting from this. We can't say an employee who is using just an ensuite is benefiting from a 11-bedroom house. So this applies whether or not the house is located in a municipal area. If the value is specified in the exempt, if the value to the employee is specified in the exempt. If the value to the employee is specified in the exempt, you know, this what you've just said here, it applies right away. You get that? So these are specific aspects of gross income. We started with annuities. Now we are on fringe benefits. And on fringe benefits, we are doing particular valuation guidelines, meaning deviations of valuing from the general rule when you are valuing fringe benefits. You can actually see that these are deviations from the general rule. Now let us go to staff loans. Staff loans. That's number 2. Staff loans. Staff loans. So important. Right? Staff loans. What do we mean by this? You know, often at workplaces we get loans, and these loans are normally at substandard interest rates or concessional interest rate, or even at no interest rates, meaning interest-free loan. So if an employer gives you a loan at 0% interest, it means the benefit to you is the interest that you forgo to pay, meaning the interest that the employer could have received is a benefit. So we can say for an interest-free loan, for an interest-free loan, comma, the benefit to the employee is the interest receivable forgone by the employer. Interest receivable forgone by the employer. The benefit to the employee, the interest receivable which the employer forgoes. And how do we calculate it? This is calculated as follows. Oh, sorry. This is calculated as follows. This is calculated as follows. So interest forgone by the employer, you calculate it as loan amount, interest forgone, loan interest benefit benefit equals, you say the loan amount, so this will be the loan amount, it will be in dollars, loan amount multiplied by LIBOR, let me say LIBOR plus 5%. Right, so this is the formula you use to calculate benefit to you if you get interest-free loan. Remember, this is per annum. It can be time apportioned. This is per annum and can be time apportioned. If you get a loan, in less than a year, suppose you get a loan for 7 months, remember to multiply by 7/12. This particular thing. Remember to multiply by, you get a loan for 7 months in the year of assessment. Remember to time apportion, because the answer which is not time apportioned is the one which will be given at the top. LIBOR stands for London Interbank Offer Rate. London Interbank Offer Rate. It will be given in the exam. The LIBOR. It means London Interbank Offer Rate. It is given in the exam. So there's no need for you to know what is the LIBOR. So suppose the LIBOR is 2%, it means the bracket here becomes 7%. You get that? Suppose the LIBOR is 2%, so it means you are multiplying the loan by 7%. So important. And then if he pays interest or pays low interest, let's say low interest, then the benefit is multiplied by, the loan is multiplied by, you multiply this loan by, you say LIBOR. Let me write it again. LIBOR plus 5% minus interest paid. So if the employee is paying something, for example, you can't say the employee is benefiting LIBOR plus 5%. Suppose I'm paying 3%. It means the benefit to me ceases to be LIBOR plus 5% if I'm paying 3%. The benefit to me becomes LIBOR plus 5% minus what I am paying, so that the benefit is the difference. It's so important on this particular point that you take note of that. You get that? And then, as an NB, on staff loans, NB, point to note, nyatso bata, that's what it means. There is no loan benefit. There is no loan benefit. There is no loan benefit if, to the extent to which there's no loan benefit to the extent to which the loan is spent on medication or education. There's no loan benefit to the extent to which the loan is spent on medication or education of the employee, spouse, or child. Are you getting it? We don't calculate staff loan benefit if the loan is spent on education, medication, or on health of the employee, spouse, or child. Let me repeat. Suppose I take a loan here of 80,000. Suppose I get a loan of 80,000, and of the 80,000, I then use 60% for my medication. Meaning, when I'm saying here loan amount here, I'm no longer going to put 80,000. I'm only going to put 20,000. No wonder why this NB says to the extent to which. Understand that phrase? There is no loan benefit to the extent to which, meaning if I use a fraction of the loan for any of these, I am taxed only to the extent of the fraction of that benefit. Okay, another point is, suppose the loan of 80,000, I use half of it for my master's degree, or half of it for my child's university undergrad degree. What it then means is, if I use half of it for my child's undergrad degree, the loan amount to put here is only 40,000, not 80. Because 40, suppose I then use it to buy a stand or something. What if I use the whole amount for half for degree, half for education, for medication? It means there's no benefit to talk about, because no benefit arises if the loan is used for medication or education, either of myself or my spouse or of my child. I don't think this can cause us to have issues. It's a matter of committing to memory. Number 3, we are delineating with specific aspects of gross income, and we are on the section of fringe benefits, and particularly or specifically we are on valuation of fringe benefits. And before now, we have just discussed how you value a staff loan. So let us proceed to value of motor vehicle benefits. Motor vehicle benefits. Now, you'll be given these motor vehicle benefits by the examiner. You'll be given these. But basically, if you are valuing motor vehicle benefits, it goes like this. You simply say the value to the employee, depends. Value to the employee depends on the engine capacity of the vehicle. The value to the employee depends on the engine capacity of the vehicle. These are gazetted annually by the legislator. These are gazetted annually by the legislature. Gazetted annually by the legislature. So you'll be given again in the exam. No wonder why I said when I gave you those notes, I appreciate that some of the points, some of the figures might not be relevant, because like in this case, they are gazetted annually by the legislature. So if you want to know if you want to know the engine capacities of the vehicle for 2020, let me open past papers like Tax Zim past papers. Are you not seeing there are quite a lot of variants for taxation papers? All these are, so when you're googling taxation papers, after saying tax, you can put a dash and say ZWE for Zimbabwe, and then you can Google it up again. Tax Zimbabwe past papers. All right. If you don't see it like this, what I encourage you to do is to come back to tax past papers. Let me click it again, because there are various ways of getting to tax exempt. You can just pick a variant. You can pick your own variant for tax past papers here. Okay. Notice Zimbabwe is here. If you come to you can notice I just clicked tax UK, but if I want my specific one, notice these they are on ACCA Global, and Zimbabwe is just down at the end by alphabet. So here is your Zimbabwe. You can just click Zimbabwe like this. So after clicking like this, you get past papers. I just want to show you the past papers, how they look like. You'll be given tables by the examiner. But for now, since this is the first lecture, I don't think it will be nice to delve into that. But since I had opened, let me just show you quickly, just a quick one. When I say these are gazetted annually by the legislature, what I mean is, in the exam, we actually give you the tables, the tables for fringe benefits that we want you to use. Okay, let me open it. I just picked any question paper at random because they are the same. It's opening. Allow it to open. Opening there. Right. Okay. Giving it time to open. You know, it's opening. It's slow because it's streaming on Skype, and at the same time it's streaming its screen. So by buffering it on the Skype, it may take some minutes. But the good thing is it has managed to open. What I want you to see is the examiner will give you the text tables. The examiner gives you the text tables. Like this is the table on employment taxes. It's not being fast enough. All these are the tables, the text tables that will be given. Of particular interest is this table, which is about motor vehicle benefits. Are you not? When I say this depends on the engine capacity of the vehicle, and they are gazetted annually by the legislature. So this is what you get in the exam. The examiner will give you the figures to use. So it's not like, will I then be in a position to know what was obtaining in 2020? You can come to your Google Chrome and say 2020 motor vehicle benefits. You can type it like this: 2020 motor vehicle benefits. Are you getting it? This is ZIMRA 2020 motor vehicle benefits or motoring benefits. You can Google it up like this. These are the things you need to know. But as you have noticed there, have you noticed that? Have you noticed that the figures to use in the examiner in the exam will be given, so there is no need. So you can see here, this is 2020 motor vehicle benefits. I'm Googling these from ZIMRA website. So 2020, you have them here. So these are the motor vehicle benefits for 2020. You can see it depends on the engine capacity of the vehicle. So you have this in your exam. Don't necessarily claim it. We will give you in the exam. So what I'm explaining here is what is here. What is here 2020? Because I'm not going to write the notes. You can copy the table. It's still fine. You can take a snapshot of it. Can someone take a snapshot of the table so that you can copy later? Can someone take a picture of it? I'm waiting for someone to take a picture of it. Oh, well. Okay, perfect. All right. So, are you not seeing that this is exactly, I opened the paper here for you to see that this is exactly the table that the examiner will give you. But the figures change because of the years. So don't bother yourself like into thinking, yeah, so we give you in the exam. What is important is for you to use it. Because you'll be told that a person was using Mazda, KB 250. And it had engine capacity of 2,200 cc. So the engine capacity determines the benefit that you get. So coming to specifics, these are annual benefits, please. These figures here, like 54,000, 72,000, 108,000, and 154,000, these are annual benefits. If the person used the vehicle for just 4 months, you can time a portion. Are you not seeing that it's actually there in black and white on Zimra website? So if a person used the vehicle for less than 12 months, you time a portion that benefit. That's another thing. Another thing on these particular benefits is that please don't lose these benefits, because I will give you assignments unless you promise me that you visit Zimra website in the same way I had visited it. I said motoring benefits for 2020, vehicle motoring benefits for 2020, Zimra. Then the page showed up and you scroll down to 2020. So in the exam, we just give you the engine capacity of the vehicle. That's what we give you. And we also give you the date the person started using that vehicle. So if we say engine capacity was 2,200 cc and the person started to use it on the 1st of August, it means we have got August, September, October, November, December. You have got 5 months. So 2,200 cc, it's in the 108 category. So you multiply this 108 by 5/12, because that one is an annual benefit. If they want monthly, you divide that by 12. That's one leg of argument. Another leg of argument is, if you are using a vehicle for solely employer's business, there is no motor vehicle benefit. There is no motor vehicle benefit. Can you imagine? You use a vehicle to transport workers. We have got drivers who use, say, a Quantum, a baby Quantum, a Toyota baby Quantum. But the driver uses this vehicle to carry employees and deliver them to their houses and repeat the procedure tomorrow and so forth. Clearly, you can't say the driver is benefiting from a vehicle, because the vehicle is used solely for employer's business. So there's no vehicle benefit to the extent to which the vehicle is used solely for employer's business. Another thing is, there is no vehicle benefit if you pay the employer to use the vehicle. Do you know that there are companies which do that? The employees pay for repairs in minute. You'll be told that your vehicle here is Toyota Mark II, Toyota Ranix or what. But here's the deal. As you are using the vehicle, you pay for maintenance, you pay for repairs, you pay for fuel. But all you do is to drive the vehicle. So if you are paying the employer for the use of the vehicle, there is no motor vehicle benefit. Another issue is, if you use the vehicle partly for employer's business and partly for your own private business, then this benefit is time is apportioned using mileage. Between the mileage you traveled when you are doing employer's business, there's no benefit. But the mileage you traveled doing your own business, there is benefit. So you time apportion these benefits. So let me come to my Excel once again. Let me come to my Excel, this one. So motor vehicle benefit, you now understand from what I have just showed you. Now let us come to NB on motor vehicle benefits. The same points I was alluding to before now. NB. Motor vehicle benefits are in annual figures. Motor vehicle benefits are in annual figures, annual amounts, and can be time apportioned. Can be time apportioned. That's the first one. Two, there is no benefit. There is no benefit if the employee pays the employer for the use of motor vehicle, pays the employer for the use of the vehicle. For the use of the vehicle. There is no benefit if the employee pays the employer for the use of the vehicle, or if the vehicle is solely used for employer's business. If the vehicle is solely for employer's business. That's another issue there. There is no benefit if the vehicle is used solely for employer's business. The benefit can be if business private mileages are given and private use mileages if business and private use mileages are given, comma, then the benefit at then the ratio of ratio of private mileage is used to ascertain the benefit. Ratio of private mileage is used to ascertain the benefit. Is used to ascertain the benefit. You know, the ratio of private mileages is used to ascertain the benefit. What do I mean by this? Suppose the vehicle in question is in which category? Is in 2,500 category. It is 108,000 being the annual benefit. It's 108,000, but you are given here like mileages. The examiner will give you all this, so it's not an issue. You are given here mileages. Mileage. Then the examiner tells you that this vehicle used business it traveled for business and for private. There was a private business and public business. So private, it was 50, it was 30,000. Private, it was 20,000. So if you are given these mileages and the vehicle is in 2,500 cc from 2,500 cc from 1st of May. Suppose the person used this vehicle from the 1st of May 2020. Clearly, the exam will give the date of 2020. It won't give another date. So here is the deal. If what will be the benefit? So you then say motoring benefit. Motoring benefit. You say 20,000 over 50,000. That's your total mileage. 20,000 over 50,000 multiplied by, it's in the 2,500 cc. You come to the table. 2,500 cc, it's 108,000. So you then say multiply by 108,000. Then you acknowledge another important fact that this one commenced the 1st of May. So it was May, June, July, August, September, October, November, December. It was 8 months. So you then say multiply by 8 over 12. The answer will be there. If you forget to multiply by 8 over 12, the answer will be there. If you multiply by 8 over 12, it will be there. If you forget to time apportion, all these suggestions will be given. So you're now saying this one here over 50 times 108 times 8 over 12. Enter. So the benefit will be 28,800. This will be the benefit for this particular vehicle. So this is what these particular points mean. These particular points. Please commit these to memory. Commit these to memory. They are so important on motor vehicle benefit. And I told you that if the employee is paying the employer for the use of the vehicle, there's no motoring benefit. Or if the vehicle is used solely for employer's business, there is again no motoring benefit. Get that? Then we want to repeat on fringe benefits, and I was on benefit number 3, which is motoring benefit. Let me proceed to benefit number 4, which is entertainment allowance. Entertainment allowance. It's another, entertainment allowance. It's when you are given money by the employer to entertain business clients. Suppose there's an agricultural show and you are given money by the employer to go to the agricultural show and company clients, be it existing or potential, but you then choose to use part of the money for your own things. If you then choose to use part of the money for your own stuff, that one is a benefit. So we can simply say the part of entertainment allowance, the part of entertainment allowance, the part of entertainment allowance, which is on employer's business. Employer's business is a benefit, hence of the employee. So So if there's entertainment allowance which is not used for employers' business, suppose you are given 12,000 to go to Victoria Falls, and then you go there with your spouse, like your wife, for shopping, and you give your wife 4,000 out of the 12,000. Clearly, the 4,000 that you then spend on private, it's a benefit in the hands of the employee, and you have to be taxed. Passage benefit, there are quite a lot. There are cell phone benefits, there are quite a lot. Passage benefits. This is like relocation at employer's request. Relocation at employer's request. If you passage benefit, relocation at employer's request, and the employer pays for the cost. You are relocating at employer's request, and the employer ends up paying the cost of that. Clearly, this is a benefit because the employer is paying the cost, but the benefit is not taxable. Benefit not taxable. The benefit is not taxable because you are not the one who chose to relocate. It's at employer's request. Then you can expand and say if relocation was not at employer's request, but nevertheless, the employer paid for the expenses, then only the first relocation benefit is exempt, the rest taxable. Rest are taxable. You get that? Let me repeat. Suppose you are in the habit of just shifting from one province to another, but it's not the employer who is requesting you to do so. But however, the employer is still paying for your relocation. Under the circumstances, only the first relocation that was paid for is the one that is not included in your benefits, but the rest they are then what? Taxable, meaning they are then included. But whenever something is taxable, meaning it is included in income, that's what it means. All right. Okay, these are specific aspects of gross income. We want to move on to, we started with annuities. B was fringe benefits. So all what we were saying were under fringe benefits. And now C, we want to discuss lease premiums and lease improvements. Now, because this one is a first lecture, you'd agree with your say that you have learned quite a lot. Let us agree on something here. Imagine if you miss out a single lecture, quite a lot of things that you lose. You lose quite a lot. And because some of your colleagues are writing exams, I don't want to overdo stuff so that they miss quite a lot. You agree with me, right? So today we want to do what I can call ethical learning, acknowledging that some of our colleagues are joining us this week. And because they are joining us this week, let us not overdo it. As you can say is in the mood to wrap up the syllabus in no time. We're almost wrapping up gross income, so that next week, lease premiums and lease improvements is just a 30-minute discussion, and gross income will be up, so that we'll move on to exemptions and and deductions and so forth, and will be like moving at an astronomical pace. So as you say, allow me to do what I always do best. Allow me today to take into cognizance the fact that some of our colleagues will join us, and if we then cover quite a lot, they may feel like, oh, we've done quite a lot. So to mitigate panic, because you are all my students, I don't want a situation where I'll be saying, like what I said, like what I said, like what I said, yet some of our colleagues were not there and we are always saying like what I said. They can then panic on a very, very easy stuff. So you now have an appreciation of what taxation is. And if you are doing it for the first time, you now appreciate how interesting the subject is. And if you have done taxation at the college or you were doing university accounting degrees, you realize that the same taxation principles apply because it is still in Zimbabwe, but the figures change. Of particular interest being the fact that you are examined 2020 tax year. So no wonder why, even in real time, I'm actually Googling on, searching on Zimra website to bring it to you that there is no other way. If it's 2020, make sure you have 2020 material for these relevant figures. So you have learned quite a lot. You've learned quite a lot. Once again, my name is Mr. Mpati. Then allow me now to stop this recording, and then we continue from lease premiums and lease improvements next week when our colleagues have joined. So I'm recording the lecture, and I trust you all know me. My name is Mr. Mpati. For those who don't know me, I'm your tutor for taxation Zimbabwe variant. I must admit you made a very good decision to enroll for tax, because tax is one of the, I always repeat this statement, and surely before you know it, you shall agree with me in no time, that tax is not necessarily a subject that gives